Welcome back. Welcome back to the hood. Today we just got two executions, very close in time. So in this video you kind of see how you can have both sides of the market framed and still be successful, but you gotta know what you're looking for. And you gotta have time. You gotta have your timing down for sure. So here, buy side imbalance, sell side inefficiency is created after breaking a swing high, two swing highs actually. So if the market is bearish, it's not gonna allow for these swing highs to be broken. When it does, if it does, also if it breaks the swing highs and also creates an inefficiency like a fair value gap or an order block, for me it's a fair value gap. That's my model. If it does that, that for me is an opportunity to get into the market, especially if I have a lot of buy side or sell side liquidity resting above my entry. Here I see a lot of liquidity on the 15-minute resting above my positions. That's the buy side imbalance, sell side efficiency that I use for my entry. I'm currently 2 contracts in, and if I wanted to keep my stop loss really tight, I would keep it under the, so it's 3 candles that make up the gap. I would keep it under the lowest candle, but I found that area gets stopped out a lot more often, which isn't a bad thing. I just want to give my trades just a little bit more room to trade. And one thing that I was doing before that I'm not going to do anymore is moving my stop losses, because moving your stop loss can get real ugly real fast. You know, I mean, here I'm risking a couple $100. Next thing you know, I'm moving my stop loss and I'm risking thousands. And if you just stick to your model and you wait for good setups and you come to the marketplace enough times and recognize the patterns and the timing and improbable or probable environments, you're eventually going to be profitable. It could take years though, or it could take a year. It just depends on your learning style and how fast you can find a system that works and how strictly you can abide to that system. But I don't know, I'm feeling pretty confident. I mean, I just started paper trading at the beginning of the month, so we're 7 months in. I've only been trading for 7 months, which is nothing compared to people. A lot of people say it's like 2 years before they started making some good money. Some people said it took 5 years. Some people said it took 7 years. But the people who, like for the cases like 5 years and 7 years, they always say it wasn't that they didn't learn anything or didn't learn from their lessons that they acquired along the way. It was more, it kind of turned into an addiction to them. Like they always had to be in the marketplace and they always had to be participating and always trying to look for setups. And that's like, if you're really greedy, it's gonna punish you for sure. So that was more like, it's like a greed problem for them. Like a lot of the times people get like really good trades, they can make a really good profit for the day, and then they want to make more and they give it all back or lose some, or they make some, they give it all back, and then they feel bad that they give it back, so then they revenge trade and then they end up losing more, because then you're not trading by your system, you're trading to make money, and then you start seeing things that aren't really there because you want to believe that that's there so you can make money. But I don't think I'm gonna have that problem too bad. I mean, I definitely do get greedy. I always want more. I mean, here it's like $600. I can make $600, but you know, part of me thinks like, wow, you can make more. And that's what makes it really hard, is there's infinite potential. There's no one telling you like, hey, you can only make this much, or hey, you can only trade from this hour to this hour. You have to keep yourself completely accountable when it comes to trading. There's just too much freedom, I think. Like, and that's why people like just go off the rails, and it's really hard, especially if you have like an addictive personality. It can get rough pretty fast. Because like, yeah, the markets are always open. Like, electronic trading hours are like pretty much 24/7. It's not 24/7. There are hours of the market where it's closed, but it's, you know, for the most part you can get on and, you know, there's an opportunity to make money. But that doesn't always mean that you have to or that you should. You should only trade when you see something that's probably gonna happen. But I've been seeing really quality trades, or I've been doing pretty good as far as my risk management. I need to work on my trade management for sure. But yeah, I haven't taken any really big losses. When I was first, like the first couple months, I was taking really big losses. I was taking really big risk and holding on to losing trades, and maybe sizing up too much, or losing and then getting right back into it with more leverage, with risking more and trying to make the money back. You kind of just got to be like, you have to be like, I don't care if I lose money. I just want to follow my system. That's what matters more. There's a lot of footage in these clips. I try to clip it. I try to crunch it down to where it's just, you know, the executions. But in order to see like the logic, and, you know, the market is not just gonna move that fast. I mean, each candle you see is 1 minute. So, but yeah, there I have my target at a low of a new week opening gap, and there's also liquidity right there, the white line. But see, this is a good setup because it sweeps sell side liquidity, and then it made a buy side and imbalance sell side efficiency, which is supposed to push price up, and it broke a couple swing highs on it while doing it. That's what makes it high probable. That's why I got into the trade. Now this was yesterday, which was a huge run. It was a huge open, massive open, and I saw it, and I saw that it was going to happen. I did participate before it opened. There it goes. Just see how it shoots right to the new week opening gaps. So there's two of them intertwined, like there's two of them stacked right real close to each other. So when they're stacked like that, really close to each other, it's like a black hole for price. As you can see, it got like sucked in real quick, which is good, especially when there's liquidity near them too, like relative equal highs, and those new week opening gaps, new day opening gaps stacked on each other. It's very high probability that it gets, you know, that price gets there, especially with the fair value gap that opened up. Pretty simple, pretty chill. Nice execution though, for sure. Ends up going up way higher than that, and then once it went higher and higher and higher, and it swept buy side a couple times. So then I was looking for a retracement back to around 50% of that big run that it traded to. And I was using the inversion fair value gap. So on the left side, it created a buy side imbalance sell side efficiency, and then a lot of times the market will use that as a means of retracement. So it trades under it, spikes into it, again to a position here. And then right now my take profit is 50% of that run. And it also traded right to Monday's first position for value gap, which is pretty cool. It's always nice to see my like the PD arrays that I have outlined, and price is always gravitating to them, going to them, from them, taking liquidity back to another one. So I have the blueprint. I just need the experience now, and it's coming. I mean, I'm not trying to rush it at all. I love to, I love to practice, and I'm treating it like if it's real money. Anytime I get too greedy or anytime I overtrade, I catch myself, and it's good to just get it out of my system now. It's pretty soon it's gonna be real money, and then we'll see. Money talks. Money talks. Yeah, you can see prices retracing. That doesn't mean that that's the bias for the day. It just means price is always gonna go back to a discount or try to take people out of their positions. So you can use both sides of the market. It's a little harder. Like if your daily bias is going up, you should really only look for positions to go up and let runs like this go down. But you can trade intraday or intra-session like volatility as well. It just has to show you that like here clearly it's an inversion fair value gap, because look, the bodies are staying below the fair value gap, but the wicks are pricing in 1, 2, 3 times, and then it fell. And nothing is random. It's never just gonna go to some random spot. It's either gonna go to an efficiency or an order block or a percentage of the range. 50% of the range is what the algorithm likes to do. Or at least that's what ICT teaches, and that's what I've seen a lot of the times. Because the market can never just go one direction forever. Like it's gonna have to come down and price in. It's gonna have to come down and turn and move directions, and that's all it's doing. It's 100% not random. I mean, if you can't tell it's not random by now, I mean, what are you doing? Forget about it. Forget about it. Like, you can never convince me that it's random after, like, what is random about this? This is really precise. It's precise, but like I don't demand absolute precision for myself, because the way I graded this range, right, from top to bottom, I don't show in the video, or I might show it in a bit, but the way I graded it, 50% of what I graded is that green lot, that my take profit, but that doesn't mean that's the actual 50% of the range, because I could have been off, because I just eyeball it. I just go from the bottom to the top. I don't like look into the prices, so I could be off, a couple handles, and so I don't just like I know there's human error in how I draw and put lipstick onto the charts. When I say lipstick, I mean like the boxes and stuff. There could be human error, and I'm not as precise as a computer algorithm. So since I just eyeball it, because I mean, you don't need to be super precise. What I have outlined already here is more than enough to navigate the markets. But when that's why I just eyeball it. And what I need is direction and an entry. I don't need my take profit to be smashed through. I just need a direction of where price is going to make money off of it. Simple. And I keep tight stop losses now. It's looking better. I still have a lot to learn, but my system's looking better. When I lose a little bit. And when I win more. Like as long as you're winning more than you're losing, then your equity curve is going to continue to go up. Whether it's steady or gradual, it doesn't matter. You just need to be able to compound your money. And it's smarter to take it easier this way. Like it's smarter to get used to it with small positions, because whether it takes me like 2 years, 3 years, 4 years, eventually when I'm comfortable enough to load up my positions, I can make back, a whole, year's worth of salary in 1 quarter, because my positions will be so large, because I'll have that confidence behind my system. So that's all it is. If you try to go too fast, too early, you're gonna fail a lot, lose confidence, you're gonna lose a lot of money, and your willingness to continue may not be so great. See, that's already really close to my take profit. It's like maybe a couple handles, a handle off or something, but what I mean by a handle is like $1. So right here I'm getting ready to just take it off, because this, I already had a great trade. I made $600. Now I'm up maybe a couple other $100. Like I don't need anything more than that. Imagine if I could make that every day. Like if you were to find like $600 on the ground, you would be like, oh man, that's cool, but like I want more. Like no, you'd be like, oh sick. You'd be like, $600 sick. So that's why that's the mindset I keep. So I'm not greedy. There's no shame in collapsing the trade. I got the direction right, I got the entry right, and that's it. That's all you gotta do to get out the hood, make it out the mud. And it does plow through it. I didn't want the clip to be super long, so I clipped it. That's it though, 2 executions. Peace.